Today is the 6th of September. So I'd like to start off with the events as usual. And today I'd like to talk about the jobs market because the data that came out was quite important for everybody to understand. Then we have a better idea what the Federal Reserve might be looking into next, right? So last week's news release seems to suggest that the US job market is cooling down, finally cooling down. But is this going to continue? We need more data from there. So we first had the job openings and labor turnover summary. In short, it's known as JOLTS report. So it came in at 8.83 million versus 9.17 million. And this data of 8.83 is the lowest level in more than 2 years. In that brought up chart, you can see it from there, 8.83. And if you look back over here, this jobs opening and labor turnover, it's at its lowest. But it's still, if it comes down a bit more, it would be better to cool down the potential up move later on again. But this is so far good progress, and definitely, we expect it to come down with the unprecedented increase in the interest rates already. And probably this year we might see just one more later on in the year, but not the next one, but probably the one after that, the FOMC. All right. So after the JOLTS report, we had the ADP Non-Farm Payroll report, which also showed a big drop. Now, it recorded 177,000 versus 371 previously. And but ADP non-farm is not, it's like a precursor, a feeling, what's going to happen next. But then we had the non-farm payroll that what came in on Friday. It came higher than forecast at 187K versus 157K. This is a revised value from the previous one. The previous one, it came the previous non-farm, we had 187,000 and they revised it down. So this time it came in a bit higher. But then again, if you take the previous one and they revised it down, and this one, it came up a bit. So basically, there's not much changes. Okay, so it's just like one taking off the other. So that part, we just treat it as something that's neutral. But then again, do remember, it's below. We are seeing a trend of jobs below 200K already, right? So other than that, the important data that came out was the average hourly earnings, and that came in at 0.2% versus 0.4. So this is another drop, and unemployment rising to 0.2% to 3.8% from a previous 3.5. Okay, so this is what the Fed really wants. And to be frank, I think the Fed is actually looking at this crossing the 4% mark right over here. And that's what they are really targeting. And in the past, articles have mentioned that they were looking at 4.5. So overall, these are all good progress. And you couple it with the previous reports, right, on the during the Jackson Hole Symposium and the other reports, the statements given by Powell, this is what they expect. And because why there is a possibility of one more, because it's still not within their range yet, and they feel that they need for just one more round of rate hikes, and probably then they will be able to settle put this inflation to bed for good. Okay, so the conclusion from the entire jobs week data suggests points to a slowdown in the US labor market. That is definite already. Okay, now if you are wondering, with such poor data, why the US stock market is rising, because it's very simple. This is due to investors speculating that the Fed would not consider raising rates further if data shows a possible cooling off of inflation. And so this is a scenario where bad news for job markets is actually good news for investors. That's why price is going up. Okay. And if you look at the statements released by the people who are in charge of making this decision, like for example, the president of Federal Reserve Bank of Atlanta, Raphael Bostic, made a remark where he said, I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary economic pain. So this is what they think that, because of all this good data, we are not going to increase rates anymore. Those are the thoughts. So bad news, they're not going to increase rates. That's good for the economy, because if they continue increasing for the economy, that is not good. Okay, these are the thoughts of it. Now, I would like to remind everybody one thing, because history always serves as a good teacher. And this bad news is good news for US stock market relationship would not last. Okay, eventually it would return to norm, and bad news is truly bad news, and the US market will eventually drop, because like I mentioned before, high interest rates environments are not conducive for businesses, and also it adds burden to consumers. Now you are seeing unemployment slowly ticking up, right? And then you're seeing the wage growth is slowly coming down. So by the end of this month, on top of that, you have a couple million of people starting, they have to start paying their student loans again in the US. All these add into the burden of these people, the ability of them to spend, and that's when this high interest rate is going to hit hard on them. Okay, and we are already seeing this happening already, because if you look at the next part I'm going to talk about, that is the GDP progress, right? The gross domestic product. We are seeing a trend of dropping GDP falling, and this related to the interest rate hike measures by the central bank already. Now, the US recorded an increase of 2.1% preliminary GDP for Q2 2023. And down 0.3% from Q1 2023. This is a down. Okay, and if you go a bit further north, that would be Canada, and we are seeing negative growth of negative 0.2% GDP month to month versus the previous month of 0.2%. So the Americas, we are seeing this drop already, and slowly but surely this drop in GDP is treated like a contagion. It's going to move on to the other continents, right? And we definitely, we'll start seeing this slowdown in other leading economies, and eventually lead to a possible recession. So with this progress, we have to double check in detail, and it's definitely a good opportunity. But in the type of thing, if it's not a recession, it may be a correction, at least a very least correction in the economy, if it's not a recession, because some may argue that it's too fast to have a recession, because we already had one in 2020, right? So we may not have a recession that fast, but nevertheless, I feel that the market will eventually come down. And when do we know that? Is when the Federal Reserve is forced to cut its rates, because they are going to leave the rates as long as possible to ensure inflation comes down and stays down. But this will also lead to another thing, right? The higher burden for consumers, and when any part of the economy crack, that's when you will see the correction in the market. Okay, so with that, that's the end of the fundamental report for today.